Thanks everyone for joining this webinar. The topic of the webinar is going to be 2026 and IFRS challenges. So I should let you know that we'll record the seminar. I don't know if we're going to be posting it later on, but it's possible that we post it in some media. So we will do a recording on the webinar. Thanks again for joining, and let me start with the first slide. So what's the agenda for today? We'll do a very brief intro on what we do and our work. We're going to discuss the expected economic developments in Europe and the world in 2026 and how that affects IFRS 9. We'll talk about some major local and global risks that we see. We'll talk about AI and what we see as effects on IFRS 9 and potentially PMAs, post-model adjustments in the models because of AI. And then we'll discuss a few specific topics regarding some effects on specific derivative contracts that may be interesting for you. So short disclaimer, please take everything that we say just as our opinion. So that's not business advice or financial advice. It's just our opinion. So please decide critically if what we say is reasonable, and you can, make your own mind based on what we share as information. By the way, the presentation, we're going to upload the presentation. It will be in LinkedIn on our website, and somebody wants, I can email it as well, no problem. So just email me. I'll send the presentation after the call. A few things about us. We do a lot of IFRS 9 work. Also, we do fair value estimations, IFRS 16 estimations, and we do a number of other analysis, including transfer pricing analysis, data analytics. We have our own platform for IFRS 9 analysis and for certain fair value estimations and also transfer pricing estimations. So just for you to have an idea, a lot of you are customers that we work with, but some people may not know what we do. You can check that in the presentation later. Our experience with IFRS 9 is very, very extensive. We do a lot of IFRS 9 reviews. We do a lot of IFRS 9 calculation estimations for corporates, for financial institutions. So hopefully the information that we share with you is going to be relevant for what you do, and hopefully it will be interesting. So let's start with the first important slide. That would be what is the expected development of the world in terms of real GDP growth in 2026. This is an estimate from IMF. This is the World Economic Outlook from October. And the interesting thing that you may take out of this slide is that I think the entire world, basically with a few exceptions, is green. It's quite green, right? Europe, where we are, is not as much green as maybe Africa, but it's green as well. So the green part indicates growth between 0 and 3%. So we would characterize the fact that most of the world is not, in the dark green area as subdued growth. So some growth is expected, between 0 and 3%. Definitely no recession is expected in the central scenario from IMF. That actually is a good sign. So it's not really high growth rates. It's not negative growth rates, but we would call that subdued economic growth expected for 2026 globally. The other key parameter that we often look into would be the inflation rates. And if you look at the inflation rates, the high inflation rates have now mostly come down. Some parts of Europe and the UK are under slightly higher inflation rates, above what most central banks have a target of 2%. So slightly high inflation, but if you can see a lot of countries in Europe, actually, the inflation is they are under control below 3%. So what we can describe the situation is, again, subdued economic growth expectations for 2026. And in terms of inflation, slightly higher than what we would like to see, but seems to be getting under control overall. If you look at the trends in GDP, that's actually interesting to see because there is a lot of interesting information in this slide. What you can see on this slide is basically that up until the year 2000, emerging economies and developed economies, they moved quite together in terms of GDP growth. After 2000, we are seeing a very divergent way of development of the emerging markets, which have much higher growth rates than the advanced economies. But in the same time, if you look at the two significant crises that we had, the one in 2008 and the COVID crisis a few years ago, you will notice that the entire world reacted pretty much in the same way. So that's an indication that even with that change in the growth rates, it's quite clear that the economies are quite connected, and a significant crisis in one economy is not going to pass the rest. It's just the effect may be smaller, as was in 2008, but there seems to be a very high relation between these economies even now. And what's also interesting in this slide is if you look at the forecast from 2025, basically the growth is now subdued everywhere. So the advanced economies have slightly slower growth than before. The developing markets have slightly lower growth than before. But if you see the forecast, the projection for the following however many years is quite flat. So no significant change expected based on the last real report from IMF. If you look at individual countries, let's start with the UK. Bank of England's estimate would suggest that the growth rate is actually quite close to zero for this year, expected. A positive, not negative, that's a good news, but really close to zero. So that's way below what should be the norm in the Western world. But nevertheless, it's not expected. We not expect a recession over there. In terms of inflation, what you might notice is that the inflation is slightly higher than 2%, even higher than 3%, but not by much. So this is kind of an example of the same thing. Yes, subdued growth and slightly higher inflation, perhaps, than we would like to see. Now, if you look at Europe and the European Union, you would notice that the three charts here, this is actually the latest estimate from the European Commission. The growth rates are pretty flat between countries if you look at 2025, 2026, and 2027. Yes, there are some differences and some outliers, in this case, obviously Ireland, with this extremely high peak here, but the rest of the data is pretty consistent. Most countries are expecting to have quite similar growth rates over this year and the next 2 years. And if you look at the inflation, a similar picture is shown, again, slightly higher than what we would like to see of the target of, let's say, up to 2% or around 2%, but nothing too high. So the question is then, so what's the risk here? What is the problem if 2025, 2026, 2027, they all look quite the same by the central scenario forecasts of all major institutions that we look into? Well, actually, there are a lot of problems. So the risks that we see now are, in our view, much higher than the risks that were there 1 or 2 years ago. So even though the central forecast has not changed, that doesn't mean that there are no risks to that forecast. And in fact, our assessment is that the risk has increased this year as compared to last year. And that's one of the reasons why we wanted to share this information with you. And from now on, we'll talk about, okay, ideally, and we expect things to be normal, things to run well, but do we actually have problems that may come ahead? And what would happen if we do actually have these problems? So let me start by the smaller risk, potentially smaller risk that we assess. That would be trade tension and climate change. And then we are going to move to the bigger risk that we see, which would be global conflict, global debt, and AI. So I'll start with the potentially smaller risks. So this is an estimate by an UN organization. And the reason why we consider trade tension currently a potentially smaller risk is because what we see is that while in the end of last year and the beginning of this year, there has been quite significant effect because of the change in world order based on the decisions taken by the US. However, in the last 2 quarters, the growth in trade is for goods and services is there. So that's a quarter-on-quarter growth. And as you can see, the yearly growth is quite substantial. So while the first effect of the trade wars obviously was quite negative, we are seeing picking up in the trade relations. So even with that new world order, it's difficult to see a kind of failure in terms of trade. In fact, we are seeing growth over the last quarters. So that's quite positive. So overall, we would assess the situation that yes, there is trade tension. Yes, there is restructuring in how trade works, but there is no stopping in trade. That's how it looks. In fact, it's increasing. So we take that as a positive sign. So of course, this continues to be a risk. We're not trying to say that there is no risk, and perhaps a sudden change in policy would not happen over a tweet or something. But the fact of the matter is, up until now, I think the world is handling it well enough, and Trade tensions have not resulted into significant decrease in trade in goods or services. In fact, the last 2 quarters indicate positive trends. So for us, yes, definitely it's a risk. It is very volatile, but in the same time, somehow I think the world is coping it well enough. So that's why we classify this as a potentially smaller risk, although obviously one should be careful with that. Like we cannot ignore that risk at all. So what about climate change? Now, as you know, climate change is very kind of important topic. It's moved into a lot of conversation. It's added to reporting now for a number of organizations and types of organizations and financial reports. So this is becoming very important. So why do we not consider this as a bigger risk? Well, quite simply because of the first number that you see here. So that's an assessment from Swiss Re. And their assessment is that that's for 2024, and the 2025 assessment is not that bigger in terms of that number. So the reason why we posted the 2024 number is because there is an indication, the last number here that you see on the screen. Okay, so there is an indication about the long-term growth in terms of these costs. So 300 billion USD sounds like a lot of money, but that's not actually that big of money if you consider the size of the global economy. But for us, what's terrifying about this number is the last two things, right? So 5 to 7% growth rate. That's very significant. The problem with this number is that indicates over time, this problem is going to become disproportionately large as compared to the economy, because the world is not growing at 5 to 7%, right? It's not happening. So while currently we have the luxury to avoid that number and say, okay, it's insignificant compared to the global markets today, the moment will come when that number is going to become big enough. And if that trend continues, that's going to be a significant issue for the entire world. So that definitely is something to consider. And that's why we have it here. Again, we classify it as a smaller risk, but that doesn't mean it's a minor risk. It just means currently, as of the current state, it's something that for the next year perhaps is not going to be the breaking risk. Okay, moving on, bigger risks. What we can say is that the assessment on the global conflict scale is actually not very good. In fact, there has been a worsening of the situation for the last year. And that's why we classified this risk as high and potentially very disruptive. If you look at this map, on that side of the world, you're going to see less green than other colors, and that's quite worrying. Basically, the world is currently having so many conflicts that half the globe is covered in some sort of conflict. That's how it seems by this chart. And the change is into a negative position, meaning more deterioration than improvements. So for us, that's a significant risk. Those of you who had any exposures to Ukraine and Russia when Russia attacked Ukraine know what happened to these exposures. Extremely high increase in risk overnight, defaults or near default credit ratings. So that's any change in that regard can trigger very significant economic damage, basically globally. So that's a very significant concern and something that we should keep in mind for next year. The next issue I'm going to spend a little bit more time talking about, which would be the level of government debt. And by the way, when I say government debt, please note that private debt is also increasing significantly. We focused on one slide because we can't cover everything, but the debt level on almost all elements that we see are increasing globally. So let's focus on the government debt for the moment. The chart below shows the debt level of various countries. Now, we picked Greece specifically and showed the number in 2009 because that's when the Greek crisis happened. And it happened at around 128% of debt to GDP ratio. The reason why that number is significant, and obviously Greece has now, largely is now recovering very well, so things are moving in a very positive direction. But while the debt level in Greece is decreasing, if you look at all the other major economies in Europe in the States as well, you're going to see a significant increase in debt. So right after the 2008 crisis, the debt to GDP ratio started to increase, and now the US is projected to cross that line of 128%, possibly in the following year. Because of the policies of the country, this debt level is increasing very, very rapidly. Obviously, we're not saying that once you cross that line, then the same thing is happening to the States. We're not suggesting that because it's a very different economy and in a very different financial and power situation. And also there are examples of economies who are doing very well with much higher levels of debt to GDP ratio. I didn't put Japan on the chart because with well over 200%, everything would look dwarfed. However, it's important just to mention that in the Western type of economies, there is a level after which this debt becomes problematic and, may I say, at some point, a little bit unsustainable, right? So that's the problem. So if you look at the entire developed world, these debt levels are having increased significantly from 2008 till now. And the projection of overall major countries is that this debt level is going to continue to increase. And again, if you look at private credit in relations to other types of credit, basically the credit has increased a lot and it's continuing to increase. If you look at the map of the world, you're going to see that some countries are in green, some countries obviously we have no data, but basically Europe, especially the western type of Europe, western part of Europe is significantly above 100%. And other big countries, if you look at China, India, yes, it's in this kind of neutral color, but indicates level close to, again, between 75 and 100%. So that's not a small number. So the debt level is high. It's much higher than it was 10, 15 years ago, and it's continuing to increase. And that's for us a very, very significant risk. And that's why we say, even though the central forecast is okay, things would likely be the same, we still think the risks are high and unfortunately increasing. So what's the primary reason why this increase in debt actually is affecting the world so much now? These are the interest rates by the major central banks in our side of the world, ECB, Federal Reserve, and Bank of England. If you look at that chart right after the 2008 crisis, the interest rates were over 2.0 or below zero or around zero for basically every central bank on that side of the world. So the important factor is because the interest rates were pushed so low for so many years, this debt level that we saw in the previous slide, that did not cause any burden, almost no burden on the economy. In fact, in some cases, we've had negative interest rates. That basically means you have to pay a country for the luxury to own their bonds, right? So that's no more. After the significant increase in inflation of 2 years ago, what happened was that central banks had to react, and what's one of the reactions that is typically associated with how to address this problem is increase interest rates in the economy, and that's exactly what happened. By the way, if you look at the chart here, you're going to notice that the trend here is that Federal Reserve and Bank of England move quite closely together in terms of interest rates. And then the ECB is actually significantly below them. So that creates a different environment than before, where things moved a little bit more closer. And that is the reason why we're going to have the last slides regarding some specific contracts. But in any case, the interest rates have now, I wouldn't say normalized, but have increased quite significantly. And that burden of over 100% of GDP ratio of debt basically means now the interest payments are becoming quite substantial. And every new bond issue has much higher interest rate than the one that it's retiring the previous one. So this is a slide that actually I added just yesterday. And this is because of that's the last slide I added after everything else was ready. I was quite surprised by this news. So ECB warned, that's from this month, that they are seeing unprecedentedly high risk of shocks. I think it's relatively rare to see a central bank warning about shocks. Usually central banks would try to calm down the situation and have a more kind of a talking point that basically supports the current situation. But we are a little bit concerned also by the ECB narrative, which basically says, yes, the forecasts are what they are. but in the same time, risks are very, very high, much higher than perhaps is visible, and definitely not visible by the central forecast. They listed, by the way, the same thing that we have in our presentation, so I'm quite happy. Almost the same things that we have. So I think definitely they have the same look on the matter that we do. So risks are increasing quite significant, and that should be considered. And then I'm going to move to the last topic of AI and what risks it could create and how it should be addressed. And I'll spend some time on this slide, and I wanted to make this slide in the way that I did, which is basically just posting quotes from various sources. I'm going to go through most of them. Why did I do it in this way? Well, because that, I think, simplifies the situation in what we actually see currently in the field of AI. So we see really a lot of chaos and very chaotic, very extreme opinions on what's happening with regard to AI and the effects on the economy. The first thing I want to say is that obviously the AI has become extremely dominant in terms of its effect on the economy and the investment. So Gartner's estimate is for 1.5 trillion spending this year. That's really very significant investment. And in fact, if you take out AI spending, the GDP growth of US will probably be much closer to zero than it is now. So that's the major factor why the US is growing right now. And I would suspect it's a major factor while other countries are growing as well, ones with significant AI investments. So the important number that to consider here is that this is not only equity investment. You may think that AI are a few companies or a large number of companies doing a lot of research and posting some models, but these models and these trainings and this infrastructure is very, very expensive. So all of this requires a lot of investments. And yes, some of it is equity investments, but a lot of it isn't. Even currently, the global debt related to AI is well over $1 trillion, and that is expected to continue to grow. JP Morgan assesses 2026 as 1.8 trillion bond sales. So we are talking a major part of the market now is going to be debt, and that debt has a very different characteristic than obviously than equity shares. So if anything happens to that debt, that's going to be a major problem, not only for the companies, but for the very, very large number of institutions who purchase that debt, banks, financial institutions, financial entities, private individuals. So if anything happens, everybody will be affected to a very, very large extent. So these very large $1 trillion investments per year, well over $1 trillion, what's the financial effect of the AI up until now? So if we look at OpenAI's last quarter result, we are talking about $12 billion loss per year. So as you can see, yearly loss, annualized loss, as they would say, would be probably about 48 billion. By the way, when Anthropic says 26 billion of annualized revenue in 2026, that doesn't mean annual revenues. That means just perhaps taking the last quarter, the best one, and say, okay, if we repeat the last quarter, it's going to be 26 billion. So the annual revenue will be lower than 26 billion. So I just want to contrast the amount of revenue, which is much, much, much smaller than the investment, with the amount of losses, which are also very, very high for that period. And it's difficult to see next year as a turning point. So we'd rather see continued large investments and potentially small revenues and significant losses over the period. In the same time, we are used to seeing news only from our side of the world. There is a model, the last model that's the Key to thinking model. It's the last Chinese model that we are aware of on that level. It's an open source model, an open weight model that actually you can download. It has the performance of ChatGPT 5 currently. So obviously you'll need a little bit of a bigger infrastructure to deploy, but it's possible to do that. What I'm trying to say is that yes, we see these extremely large investments in infrastructure and in new models, but the competition is there. The Chinese models are extremely good. They are much more efficient and much cheaper to have than the models that are currently developed by the primary developers in the US and in Europe. So that's something to consider as well. So it's not one-sided race. There are very much two sides to this. In the same process, what we see in the financial effect on companies, Microsoft, for example, extended their server depreciation now to 6 years. Before it was less, and so the same is true for Google and other entities. But how long will this infrastructure actually last? So NVIDIA's next generation of infrastructure, the Rubin chips and infrastructure, is expected to start deployments end of next year. So that's in about 2 years' time. And the one after that is expected to happen in 2028. So if we expect that timeline, major infrastructure change maybe every 2 years. Because this new infrastructure is not a small improvement. We are talking here of many times, almost a magnitude order of change in performance. That basically means if you are into this race, it's very difficult to say, I'm not going to upgrade to the new server simply because you're going to be left out of the performance competition and the power competition. So it's very difficult to ignore this trend. Basically, new technologies are replacing the old technology very, very quickly, possibly way quicker than the 6 years expected. But let's see also some quotes from the industry, right? So Anthropic CEO said that about 6 months ago, said that he expects 90% of the code to be written by AI in 3 to 6 months. Obviously, that's not happening. We're nowhere near that number. However, a lot of programmers, especially in the US, have lost their jobs. There is a hiring freeze. So if you're in that field, very difficult to get a job. What that basically means is, yes, we're not seeing that by no standard. We are anywhere close to 90% of the code being written by AI. We're very far from that number. But in the same time, the real effect is there on humans, right? So no hiring on such positions now. But the reason why we have that here is just to see the wild expectations that people have, and maybe not the reality is obviously very significant effect. So we're not questioning the effects, but perhaps maybe not to that extent. And if you look at Jeffrey Hinton's, who is one of the godfathers of AI estimate, he actually assesses a 10 to 20% chance of AI, existentially perhaps destroying human race, for lack of a better word. I actually think that's potentially not that far from reality if we don't do it well. But obviously, this is not a next year thing, right? It's a longer term assessment. In any case, if you look at the situation, the risks are there. The promises, some of them met, some of them not. But in any case, we're seeing a significant change in possibly every company in the world that is trying to adopt AI. So overall, we're not questioning that AI is extremely useful. Obviously, that's the case. We use it. I assume every single person on this call uses in some form AI. The question is really, will these extremely large infrastructure investments and open source and model investments and open source model investments from China lead to the result that actually justifies these values? And that's a big question mark really at this stage. So let me entertain 2 possible extreme scenarios for next year. And the scenario on the right is that AI companies somehow reach to what's considered AGI, and essentially we have an AI that's, let's say, smarter than humans and can do the job of humans in general. So that extreme picture, that really happens, and at the moment it doesn't seem to be happening. But if that happens, because I think a lot of the investments foresee that, and that's underpinning factor in saying we're going to invest several $1 trillion in that thing. So if that actually happens, from IFRS 9 point of view, we are going to see a lot of negative effects on a number of companies which are more human-based companies, right? So we're not saying that AI is going to replace humans everywhere. That's not going to happen. But definitely a lot of companies, especially ones that don't adapt with that technology, going to have very, very significant issues. And there'll be a lot of human cost to that, which is outside of the IFRS 9 analysis. But from IFRS 9 point of view, if there are new technologies that replace humans, and you have companies that, if you're a financial institution, you actually financed, you invested in these companies in some way, or you did something with these companies, the risk for them are going to be extremely high. Simply because if AI replaces these type of businesses, then that business goes to now the AI companies and not to the company and the business that was doing it before. So that extreme case, if that happens, then we're going to see a very, very seismic shift in the economy and extremely large losses, in our view, on certain investment types and companies that are not part of that ecosystem that is going to be developed. On the other side, the other extreme view is, look, it's all a big bubble. Everything is going to disappear, and it's going to burn and crash. So that's again a very extreme view. Notice both pictures are created by AI, by the way. But notice the fact that the balloon, below the balloon, there is also a fire, right? So I didn't ask the Gemini tool to do a fire on the ground, but that's exactly what it did anyhow. So the importance of that is actually very, very big. If you think that if there is an air bubble and it bursts, it's not going to affect the other part of the economy. That's not going to be the case. So if this thing bursts because of the extremely large debt that even today we have in infrastructure, and you should know that even companies that historically have not used debt significant, like Microsoft, even they have debt now, right? So because these $100 billion and $1 trillion investments, they need money to come from somewhere, and the operating cash flows are just not enough to cover that. So if that happens, we're going to see very negative effects overall in the economy as well. We're talking about obviously loss of value, loss of purchasing power of anybody who invests in these companies, financial losses of companies that actually have financial exposure to these businesses. There are also going to be changes in the multiples in transactions. So that means any future transactions, fair value estimations will be down. So across the board, we're going to see a lot of negative effects if that extreme scenario again happens. So the end result will probably be somewhere in between, right? So we don't know exactly where. But I want to point just to the fact that in any of these extreme scenarios, there are going to be very extreme losses on the specific types of entities, and that's something that should be considered. We don't know exactly where will we be, and as of today, we don't know if the left scenario will be true, the right scenario will be true, or I don't know, maybe most likely something in between. But what we are suggesting is that you have to keep an eye on the situation and how it develops, because it's not going to be, the effect may be very, very significant on this. So the next question is, can we foresee crisis? So that's the World Economic Outlook on the economy from IMF from April 2008. So just before the last human-made financial crisis. And I'm not going to go into COVID, but let's say the last financial human-made crisis, right? So if you look at that, you'll notice that the forecasts were actually not that bad. Yes, the US forecast decreased significantly from the January assessment, but it's still positive, and Western Europe is largely, reasonably good expected growth. The reason why that's important is because, yes, we are able to foresee something, obviously, because the forecasts were all decreased. So there is a universally expected decrease in these growth rates, but we're not able to see everything. Obviously, nobody forecasted the same large crisis that happens. So I'm just trying to contrast to the fact that with today's forecast, again, we're not saying that there's going to be a crisis in 2026. We're not forecasting that, but it's a possibility, and it's a rising possibility given the risks that we currently see. So what happens when there is a crisis, right? So what happens to default rates? That's an interesting assessment. That's from Moody's. And basically what you see is that default rates increase very, very dramatically. In some years, default rates with a, let's say, good year and a bad year can have 8, 10, and more than 10 times difference. And that's basically saying, look, yes, you have a risk assessment, you have a assessment on the credit rating of a company, but the key factor is how is the whole economy moving? Because that risk assessment is more assessment of where that company is within the whole economy, rather than saying that's exactly the PD of that company. And our concern is if things start to deteriorate, there's going to be a lot of defaults, and it actually doesn't even have to be defaults. If you look at significant increase in credit risks, and if you have long-term exposures and the credit ratings start to decrease, the effect would be that a lot of exposures will move from stage 1 to stage 2, and that may have a lot of negative effects on the estimations of losses. Recently, we've been working on bond exposures that are going to run up until 2050. So that's 25 years from today. Now, imagine what would happen if that bond exposure moved from stage 1 to stage 2. Right? The financial loss is going to be very, very huge, just because the PD that we're going to be looking now is not going to be for 1 year. It's going to be for 25 years. Right? So that's a significant issue. So any worsening of the financial situation, global, even 1 or 2 notch decrease in the credit ratings on the institutions may lead to a very significant effect on losses. So big question, do you think there should be a PMA on the post-model adjustments on the model estimates right now? It's difficult to recommend that based on the current situation. So I can personally say, if I knew which of the two scenarios, let's say with the AI we're going to be in, I would definitely say PMAs are needed if we know that's going to happen, right? Today, we don't know that. But our suggestion is just keep a close look at how things are developing over the next 1 or 2 months, because we expect changes, and if there is nothing happening, that's great. But if there is a significant shift in either direction, right? So either something moving closer to AGI or something moving closer to burst of the AI bubble, for example, or in fact any other risk that may pick up, we very much suspect that the standard models are not going to capture that. So then PMAs are going to be important. So please consider that. If the information available as of the end of the year is very different from today, very likely models will not capture AI bubble bursting or AGI replacing all call centers or something like that, right? So that's something that you should consider. Finally, I'm going to talk just briefly on two types of contracts that are going to be affected by the current situation. So, as I mentioned before, there is now somewhat of a disconnect between ECB and Bank of England, and also ECB and the Federal Reserve in terms of interest rates. And the difference in yield curves shown on the right is actually very, very significant. Basically, the yield curves in Europe are significantly lower than the ones in UK and in the US. And in this case, we just did a calculation on UK to estimate and comparing the exchange rate between euro and British pound. But if you look at the dollar, it's pretty much a similar picture. So if these yield curves continue to be like that, using just parity estimation on forward exchange rates indicates that the euro is going to strengthen very significantly compared to the dollar over the next 20 years, and very significantly compared to the pound over the next 20 years. Obviously, this could change again very quickly, but as of today, if we have to do financial estimates on long-term contracts that relate to exchange rates in any way, shape, or form, then that may have a very significant effect on the valuation of such contracts. And in fact, we see it this year. The contracts that we see, long-term swaps or other contracts that have currency involved, are changing quite significantly this year, simply because of the fact that the yield curves now in Europe and UK, and also in Europe and the States, are now very, very, very different. There is a large disconnect between the two. And the next contract that I want to talk to about are contracts related to inflation. Now, this could be inflation-linked bonds, or could be just inflation-linked swaps. What you should be aware of, that such contracts, they typically have not the current inflation rate, but the inflation index, and the index is compared as of the exposure initiation to the current level of the index. That basically means if you have 1 or 2 years with very high inflation, that's going to uplift any single year after these 2 years with that inflation rate. So that's this inflation peak that we saw up from a few years ago. This is going to stick to the contracts, and it's going to have effect on such contracts in the longer terms. And we've seen contracts that changed basically for 2 or 3 years, just for 2 or 3 years, from being a significant liability to a significant asset from one side. And obviously, for the other side, it's the opposite, from a significant asset to significant liability. So we don't know what's going to happen to inflation, but as we said, it's a little bit higher than ideal. And if you are taking part in such contracts or assessing such contracts, please be aware that these high inflation rates are creating kind of significant issues for valuations, not the value itself, but just could create very significant losses or gains for that matter. And in our view, this should be considered for future contracts as well. So to summarize briefly the picture, what we see currently is the following. If you look at the main central forecasts from EU, from Bank of England, from the US, you're probably going to see a picture of kind of steady current state situation being moved over forward. Yes, low growth rates, lower than historical and lower than we would like to see, but positive growth rates and perhaps slightly higher inflation, maybe slightly higher than the central banks aim for, but nevertheless not 10, 15% that we had a few years ago. And while that is the central forecast, this year our opinion is that there is a significant increase in global risks, and the global risk increase comes in the following forms. Smaller risk perhaps would be trade tension and climate change for 2026, although climate change will likely pick up for the following years. But global risks definitely on the table, and we should be careful with that. And if there is significant change there, obviously post-model adjustments and changes in the models are needed overnight. Just to remind you, when the Russian military attacked Ukraine, there was an almost immediate change in the credit rating of both countries. And currently Russia isn't rated, and Ukraine's credit rating is very, very low. That basically signifies that any such change, military change, have a very, very profound change on the economy. Either the whole country is moved to default or is moved to just a few notches above default. So very, very high risk environment. And if you have exposure to these countries, because of the typical policy that no company should normally have higher or significantly higher exchange rate than the country, what that means is that the rating of the country now is going to drag down the rating of every single company in that country. So as a best case scenario, you're going to move into stage 2, and as a worst case scenario, you're going to move to default. That should be considered. And finally, AI is a big question mark. It seems to us that that's a big bet that AI is going to change the world. So and it will obviously in many ways change that. The question is how fast and to what extent. If the AI companies are right, all these trillion-dollar investments will lead to much, much higher effects for them. And that would signify that the investments are, it's not a balloon, but solid investments. If that happens, a lot of significantly negative effects probably for the human side of the economy, if we can put it that. If the bubble bursts, I think, again, a lot of negative effects for the human side of the economy, but potentially for many other businesses as well, simply because now we are not in a situation where people invest their own money in equity. A lot of this is now debt financed, and possibly a lot of institutions are now related to that in one way or another. So even if you think that's something happening primarily well outside of Europe, as Europe is quite lagging in terms of AI, doesn't matter so much because, as the previous charts show, if there is a crisis, it actually affects everybody to a different extent, but yes, it does affect everybody. In this case, the size of the debt and the equity investments are so large that that effect is going to be likely felt everywhere in the world. With that, I'm going to close the main part of this presentation. I hope you like that. We thought that we're going to leave a few minutes at the end just for Q&A session. I have my colleagues also on the call, so if anybody wants to ask any question, please feel free to do so. We'll be happy to try and answer them. I'll give a few minutes. Okay, I don't see any questions, so presumably either it was very clear or it was not clear at all. I hope it's clear enough so that things are now quite kind of self-explanatory. I'd like to thank everybody for participating in this webinar. We are going to be sending the presentation to whoever wants. Please email me if you want the presentation, or you can download it from our website, or you can get it from LinkedIn. We'll post that later today. If you have any questions for us, just email us as well. Thanks again, and good day to everybody.